Ron Insana is a CNBC senior analyst and commentator, also a senior advisor to Schroders North America. He's a senior. This is a senior. That's all he is. How are you, man?
Not officially.
So what is the sound that you're hearing that is breaking apart from what I would call the dissonance and the gear grinding that's going on with the Bank of England and the new government there?
So, Tyler, we all go back to these points in history, whether it was the Latin American debt crisis in 1981 or Mexican peso crisis in 94, Asia and long-term capital in 97, 98, whatever it was, when the Fed was wildly restrictive, something broke. And I think the UK is the canary in the coal mine here with these liability-driven investment programs that caused a great deal of illiquidity in the British bond market, so much so that when the Bank of England intervened, it drove long-term interest rates down over a full percentage point. And we're hearing, at least, or reading that, to some extent, we're seeing similar exposures in U.S. pension funds. And that had that situation in London gotten out of control, you would have had a massive and potentially systemic British financial problem that would have had some contagion effect. So we're getting close.
You've got, I guess, in Britain, if I'm understanding it correctly, you have a new government that's coming in and is saying we are going to borrow hundreds of billions of pounds, in part to subsidize energy issues and help average Britons get through the winter. Okay. Right. At the same time, the Bank of England is trying to raise interest rates. And at the same time, the Bank of England now says, well, we've got to come in and we've got to do quantitative easing here, buy up these bonds, or else there's going to be a problem. It's all seems to be working at violent cross purposes.
Absolutely. You've got, to a certain extent, the same problem at the European Central Bank, which is buying the debt of peripheral countries like Italy, Spain, and Portugal, all of which are heavily indebted. And so on the one hand, they, too, are engaging in a form of quantitative easing while also engaging in higher interest rate policy and quantitative tightening. So, yeah, cross purposes for sure. But this is the type of environment. And again, we've seen this time and time again through financial market history where you get aggressive actions by central banks that literally break a financial market. The contagion spreads or is very much in the risk of spreading to other nations. And that's when central banks stop. And we've seen this. I don't really care what the Fed says. I don't care what they're planning. I don't care how many times they say that no factor will stop them from raising rates. And I know folks like Larry Summers and others, a former Treasury Secretary, are pushing them to be even more aggressive than they are now. Something will break, and they will have to change course.
Ron, Richmond Fed President Tom Barkin is speaking right now. He's reiterating what Lael Brainerd said earlier today, saying the risk of stopping this inflation fight too soon is a bigger risk and that it is possible to control inflation without a significant downturn. We got this week initial jobless claims falling less than expected. We got the consumer confidence rising more than expected. We got new home sales more than expected. We got home prices moderating more since April of 2021. Rents declining, durable goods orders rising, and the Richmond Fed saying that regional manufacturing was zero, but again, better than expected. There's a lot of silver lining here. So what do you know that the central bankers, including our own Fed presidents, do not?
Okay, I guess that's a fair question. I think, first of all, I think they're misreading history. I don't think this is the 1970s. I don't think there's a risk of Jay Powell being Arthur Burns or G. William Miller or another central banker who made an extraordinary mistake during an inflationary period that lasted over 15 years as opposed to 15 months. Secondly, all forward-looking inflation indicators have already broken, and gasoline is down significantly. Housing prices have turned lower. Mortgage cancellations are up at near record levels. And so we're seeing, as Nike said, a huge buildup of inventories, which is also emblematic of the fact that supply chain constraints that have been driving up prices are easing dramatically. So I think they're going too far. They're going to risk something blowing up in financial markets. And again, whether it was 94, where everybody said they achieved a soft landing, Mexico had a debt crisis that we helped to fund. Orange County went bankrupt, and the Fed stopped raising rates. Yeah. So this is not unusual, and it's not out of line with historic norms. Again, whether they're seeing this or not seeing this is an open question. But I really think, based on history and my study of it, is that they're just plain wrong at this juncture with how far they want to go.
Or maybe Jay Powell is just waiting for Orange County to cry uncle. Ron Insana, it's great to see you, friend.
It might be a pension fund rather than Orange County.
Or that.
Yeah.
Yeah. The man knows his history.